Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're evaluating Amazon and Netflix stock ahead of their earnings releases next week. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look in some of our services, portfolios, and more. All right, so before we jump into Amazon and Netflix, I want to give a broader market overview and then look at the broader earnings picture to give a better sense of what's going on with Amazon and Netflix. So the market posted its best week in months last week and followed that up with another big showing on Monday, with the S&P 500 now up over 4% in the last month as it regained some momentum from its early September drop. So this positivity comes as Wall Street grows a little bit more hopeful about the possibility of a second stimulus bill, perhaps even come before the November 3rd election. But you never know at this point. It's changing every day in Washington. And meanwhile, some analysts in firms are pointing to the fact that there could be a more decisive victory in the presidential election. So this would create less uncertainty and volatility. On top of that, you saw the U.S. unemployment rate fall to 7.9% last month, with 11.4 of the roughly 22 million jobs added back since they were lost in the major layoffs in the spring. And we also know, which we're going to get into a little bit later, that the overall S&P 500 earnings outlook is supporting these positive trends of unemployment figures going in the right direction. Obviously, there's still some industries that are being crushed by the coronavirus, such as travel and hospitality, but things are trending in the right direction. And even some of the worst hit areas of the economy are trending maybe better than some would expect. And we're going to actually jump into some airline data in a second. Obviously, there are still unknowns on the virus front, though. So at this point, though, as we know, it's been 6+ months of this, the only real logical choice at this point is to learn to live the best we can with it and hope that the vaccine comes sooner than later. At this point, there could be more near-term volatility with the election so close. But if you have a longer-term investment horizon, you don't really need to try to time the market so much, and it often actually can prevent you from taking part in some of the biggest gains. So we have examples of this just recently. So think of all of the people, and it happened to millions of people that sold perhaps in early March and then didn't buy back until late June. You missed most of that massive rally from the March 23 lows. So the goal, if you can, is to try to stay as exposed as possible to the market at all times. This is obviously based on your own investment timeline and your risk appetite, but it's also worth remembering that these market corrections are a healthy and just a fact of life in the market. So there's been 24 market corrections since November of 1974. 5 of them have turned into bear markets, which includes this past spring. So as we mentioned, 24 since 1974. This is clearly just something that's going to continue to happen. And it's a healthy part of everything. With that said, the Fed's decision to keep interest rates pinned near zero through at least 2023 likely creates a prolonged TINA effect. So that's that there is no alternative. This is going to cause, hopefully, for investors, Wall Street to continue to hunt returns in a market that's pretty starved for yield. So that should help support stock prices. And now we're going to jump into a little bit of the earnings picture before we jump into Netflix and Amazon. So it's worth pointing out that the busy part of the Q3 earnings season officially kicked off this morning, so Tuesday morning, with the big banks, JP Morgan, Chase, Citigroup. So JP Morgan posted better than projected earnings. We also saw Delta Airlines fall about 2.5% in morning trading after it reported a net loss of $5.4 billion for the September quarter, with sales down 76%. And that 76% number might be shocking, but it's also maybe perhaps a little better than some people would expect. We should also note that, as I mentioned earlier, we're going to touch on the broader airline space at the moment is a little bit better than even I expected. And I've been trying to follow this a little closely because it's a good proxy for where we are in terms of sentiment for people traveling. So the number of travelers passing through U.S. airports rose to its highest level since mid-March this week, while it's still down more than 60% from a year ago. But 60% is a lot better than it's. I think sometimes the narrative out there is that travel has come to a complete screeching halt, and obviously business travel is down big because if businesses don't need you to travel, you'll now be doing Zoom, all of that jazz. But down 60% from the year ago period is likely better than a lot of people thought, and we're now back to its highest level since mid-March. So continuing to all trend in the right direction. And if we look ahead, we're going to see results from Goldman Sachs, Bank of America, United Health, Walgreens, and some other big names due out later this week. And then next week, along with Netflix and Amazon, we have the likes of Intel and Tesla, Verizon, Procter & Gamble, and then some other economic bellwethers as we continue into the heart of the third quarter earnings season. So with all of this in mind, the overall Zacks estimates call for S&P 500 earnings to decline about 22% in Q3 on about 3% lower revenues. But this would mark big improvement from last quarter's 32% decline and 9% revenue decline. So trending once again in the right direction. And I say all of this just to help reinforce that the economy and the earnings picture are continuing to move in the right direction. So if we look ahead to Q4, our Zacks estimates are calling for a 13% drop for S&P 500 earnings and just a 1.2% revenue decline, with growth then expected to return in Q1 and then bounce back in a big way against the easier to compare Q2 results from 2020. Now we're going to jump into Netflix. So just for anyone who doesn't know, Netflix trades under the ticker NFLX. And we should note that they're expected to report their Q3 results on Tuesday, October 20th, so a week from today. And now we're going to dive in to help investors determine what they might want to do with Netflix and to see if they still want to consider it as a solid longer-term investment. So if we look back over the past couple quarters, Netflix added about 16 million paid users around the world in Q1. This crushed its 7 million user guidance that it provided, obviously, before the coronavirus dramatically impacted the US and global economy. So that big beat they couldn't have seen all these people being forced to stay inside their homes and decide to buy Netflix at the moment. Then the more impressive beat actually came in Q2, in my opinion. The company pulled in over 10 million subscribers in the second quarter to blow away its own 7.5 million subscriber projection. So overall, the company added about 26 million paid subscribers during the first two quarters of FY20. This came in just 10% less than it pulled in all of 2019. And it closed last quarter with about 193 million global paid subscribers around the world. So obviously the coronavirus has created a pretty unique situation. There are hardly any movies in theaters, and the release dates of the big Hollywood movies are being pushed back by months and sometimes years until studios feel confident that people will show up in crowded theaters. And the early numbers suggest that this could take a while. And we even saw Regal Cinemas, which is the second largest U.S. movie theater chain, announcing that it's closing its doors again, not that long after reopening, citing the fact that there are no movies and people aren't coming to the theater because there are no movies. So it's sort of like a self-fulfilling prophecy there. So this all sets up solid backdrop for Netflix. So the company is the largest streaming TV firm in the world, and it obviously does face competition, especially from newcomers like Disney Plus, Apple TV Plus, HBO Max, Amazon Prime, and others. Luckily, though, for Netflix and these other streaming players, the industry is not a zero-sum game. So consumers are often subscribers to more than one platform. So this is unlike, say, Apple Music versus Spotify, where the streaming TV firms offer, for the most part, pretty vastly different libraries. So taking a near-term coronavirus view, Netflix stands to benefit greatly as these movie theaters and concerts and sports with fans and attendance, especially all around the country and all around the world are maybe some of the last things that are going to return, even as the economy slowly becomes more reopened and people return closer to their normal lives. But those things, those mass gatherings of movie theaters and concerts and sporting events will be some of the last things to return. And then obviously, more importantly, aside from the coronavirus world we're living in now, Netflix is set to grow as part of a larger secular trend that isn't likely to reverse. In this, we'll see millions of more people projected to cut the cord completely in the next several years alone. And then once more people are used to not seeing ads and watching things from the comfort of their own homes, maybe movie theaters could face even more pressure down the road. But the streaming world is here to stay. And this is evidenced by the fact that the biggest companies in the world have gone all in. This is Disney and Apple and Amazon Prime, and all of the biggest tech companies in the world have relatively some exposure to the streaming TV market. So now we're going to look at some more fundamentals for Netflix. So Netflix has spent the last several years beefing up its original content library with everything from big budget movies and series to reality TV shows now. And this has cost the company billions and billions of dollars, and it continues to take on debt to fund this content push, which is, though, more necessary than ever as the biggest companies are going all in on streaming, taking their content and putting it on their own platform. So Netflix has seen this coming for a while, and pretty soon we might see a world where in maybe 5 or 10 years, Netflix has mostly its own programming, which is where we're trending right now anyways, and that all of these companies have just their own content or whatever they're willing to spend a lot of money to have on their platform. Obviously, at this point, Wall Street isn't, or clearly doesn't appear to be that worried about Netflix's growing debt load, and investors might not need to be that nervous about pandemic-related delays to its production schedule because the same situation is happening throughout the industry. So this isn't affecting just Netflix. So we should note that its shares currently hover at around $550 per share. This is as of Tuesday morning, which puts it about 5% off its early September highs as it fights its way back over the last several weeks. So overall, Netflix stock is up about 70% in 2020 and 90% in the last year. Let's also remember that Netflix was one of the top performing stocks of the entire last decade. So I guess we'd call that the 2010s. This includes hitting a rough stretch between the summer of 2018 and the fall of 2019. But since the fall of 2019, it really hasn't looked back since then. And it's continued to climb, and it didn't really suffer a big sell-off because investors saw that the coronavirus is going to be actually a big strength for Netflix. So despite sitting right near its all-time highs, we should note that Netflix trades at a slight discount compared to its own two-year highs in terms of forward 12-month sales. It's trading at about 8.4 times forward 12-month sales. And investors might be somewhat surprised and happy to know that this marks a discount compared to a big company like Microsoft. So for all of some thoughts that maybe Netflix is a little overextended, a little overvalued, it's trading at a discount in terms of forward sales to a much larger and more established company like Microsoft. So now we're going to move on to what to expect going forward. So the only drawback from Netflix's big first half of this outsized subscriber growth was that it created what the company and executives called a pull forward, which means that some people who were going to join Netflix in fiscal 2020, instead of maybe doing it in the third quarter or the fourth quarter, they just did it in the first quarter or second quarter. So the company is now projecting they'll add 2.5 million new paid users in Q3, which would come in well below analyst estimates and represent some of its slowest user growth in years, with Q2 of 2019 really the only comparable figure at about 2.7. So the company is calling for 2.5 million paid users in Q3. So with this in mind, Zacks estimates call for its Q3 revenue to climb about 22%, with Q4 projected to jump 20%. That said, both of these would mark slowdowns compared to Q1 and Q2. Obviously, this is based on user growth. Overall, the company's fiscal 2020 sales are projected to climb about 23.3% to roughly $25 billion, with FY 2021 expected to come in another 17% higher. As you would expect, these estimates once again come in below some recent years, with FY 20 expected to match what the company last saw in FY 2015. So fiscal 2015 would be the last time the company grew at 23%. It's done far bigger growth in the last several years. That said, it still represents solid growth for a company of its size and age, and it compares very favorably against some of its FAANG peers. And then meanwhile, at the bottom end of the income statement, Netflix adjusted Q3 earnings are projected to surge about 44% to $2.12 per share. And its full year adjusted earnings are projected to jump 52% and then another 40% in FY 2021. So a good sign on the bottom line for Netflix as well, as it continues to grow its top line. And obviously, we know that these estimates come in far better than what the overall S&P 500 looks like, and the tech sector of the S&P 500 as well. So with that said, Netflix is a Zacks rank number 3 hold at the moment that has seen some positive earnings revisions recently. And it's worth remembering that Netflix stock has historically traded pretty heavily in the near term after its releases based on subscriber results and subscriber guidance. So if you're trying to play Netflix stock, you're basically betting on a near-term growth, being that it's going to beat its user subscriber figures. This might not be a bad bet, given that the coronavirus has impacted entertainment and the economy for maybe longer than some people might have thought, even over the summer. So not a bad bet, but that's that near-term. As a longer-term play, Netflix, even though it's been one of the best stocks over the last decade, the streaming TV industry is here to stay. It's only going to grow. Netflix has established itself as a key integral player of that market, and it's one of really the only pure plays of the streaming stocks alongside Roku. So in general, if you're bullish on the overall streaming market, it's not too late to buy Netflix if you're still high on that overall market. But as I said, the near term, it's going to trade based on what it does on the subscriber growth figures, most likely. And now we're going to move on to Amazon. The company trades under the ticker AMZN, and it is set to report its next quarterly results on Thursday, October 22nd, so next Thursday. And right off the bat, I want to quickly touch on what might be, I guess you could call it the elephant in the room, and this is Amazon and some of its big tech peers coming under further antitrust scrutiny in Washington. But that said, the probe into the tech giants is hardly sure to end with anything close to a substantial shakeup, and Wall Street has highlighted its lack of concern by running up many of these stocks to new highs until that early September downturn. And then we'll see that Amazon has already fought its way back up right near those new highs. So we do know that we'll just quickly go over the antitrust. So Amazon, Apple, Google, Facebook have all essentially come under scrutiny in Washington for their outsized impacts on consumers and various marketplaces. Amazon itself has faced criticism about the fact that it competes against other retailers and third-party sellers on the platform that it controls. Yet, Amazon and CEO Jeff Bezos have highlighted that retailers like Target and other places essentially do the same thing in their brick-and-mortar stores and online. And the company is sure to fight back against any legal action that might possibly be taken. And the antitrust case becomes a little harder to prove, and it might have to sort of change the scope of things when we consider that antitrust is originally based on consumer being negatively impacted, when it's hard to say that Amazon has negatively impacted consumers in terms of just pure pricing. When it has helped lower prices for consumers, it's also forced the industry to stay competitive in terms of pricing and catching up on delivery and digital sales. So obviously this has hurt smaller brick and mortar places, but if we're just looking at terms of pure consumers being the beneficiary of lower prices and new ways to get goods and services, it's a little harder to argue that Amazon has been a huge negative or going to be able to succumb to any antitrust lawsuits. So with all that said, it's all still kind of up in the air, but it's definitely worth keeping an eye on if you are someone who wants to consider investing in Amazon. That said, the Seattle powerhouse really is tailor-made to thrive in a world where consumers are stuck at home and businesses and schools work and learn remotely. The company topped our Q2 estimates at the end of July, with its adjusted earnings up 97% and revenue up 40%. And this was at the height of the pandemic. It marked its strongest top-line expansion since the first quarter of 2018. The company is committing to hire over 100,000 new workers and employees. This comes as millions of people are being laid off around the country. That just helps show how powerful Amazon is at the moment. Its online store sales were up about 50%, third-party seller services up 52%, Prime heavy subscription revenue up 30%. I could go on and on. The company showed its strength in Q2. We should also note that aside from that core e-commerce business, the company, as we mentioned, makes money from that Prime subscription service, which includes its Netflix competitor, Prime Video. The company also is set up to make money in the long term from its highly successful AWS cloud computing unit, which was already booming, and the coronavirus has helped really spur that business as more companies speed up their digitalization and remote capabilities. We should also note that it has beefed up its digital advertising business. It's now the third largest digital advertiser behind only Google and Facebook. So really it has more businesses than ever before, and they're all able to grow during the coronavirus, which if you can grow during this economy, why couldn't you grow for years and years to come, as it's one of the toughest environments to grow their business. And as we mentioned, Amazon is tailor-made to deal with this. So it's highlighted that it's built for the future, which they've been saying for years and years and years. So with this in mind, our Zacks estimates are calling for Amazon's quarterly sales to jump about 33% to a whopping 93 million. This is set to help lift its adjusted earnings by about 73%. We should also note that today, the 13th and the 14th, are going to be Amazon's 2-day Prime Day, and this is instead of its regular July run. So this should help boost actually its fourth quarter sales. And then looking ahead, Amazon's fiscal 2020 sales are projected to surge 32% to $370 billion. This would easily top last year's 21% revenue growth and top FY 2018's and 2017's 31% sales expansion. So big growth for Amazon and bigger growth than it has done in the last couple years. And if we look ahead to FY 2021, sales are expected to come in another 18 or $66 billion higher than what they did this year. So the company just continues to expand at a really rapid pace. And then on the bottom line, it's projected to climb 40% this year and then another 43% next year. So along with that top line growth, some impressive adjusted earnings growth as well. That said, we should note that the company has seen a few downward earnings revisions recently. This helps it hold a Zacks rank number 4 sell at the moment, but it's worth noting that these ratings are fluid and they're based mostly on these bottom line revision activity, almost exclusively on 4 different categories of earnings revisions. So these can change as analysts update their bottom line estimates as we get closer and closer to Amazon's release. With that said, Amazon stock is up about 90% in 2020. This helps it crush all of its FANG peers. It's also up about 100% in the last year. This includes a 12% jump in the last 4 weeks, which has it racing back up to its early September highs. And despite this strong run and trading right near its highs, Amazon trades at a discount against the S&P 500. In terms of forward sales, it's trading at about 4.1 times forward 12-month sales. This also comes in well below some of those fellow pandemic high flyers, such as Etsy comes in. Shopify is trading at about 40 times forward sales compared to Amazon's 4 times forward sales. Alibaba is trading at about 7 times forward sales. Apple's even trading at 6.8 times forward sales. So Amazon looks to be a stronger play on that valuation side if you want to look at forward sales at trading 4.1 times forward sales. So overall, we've talked about it, and most people know about Amazon pretty well. The company is built for the coronavirus economy, and therefore it's built for the future. In longer term investors, if you can stomach the high stock price itself, it's certainly not too late to get in on Amazon, which you would assume the company is going to be able to continue to grow for years and years to come. But obviously, both with Netflix and Amazon and any stock playing it for the near term is far less certain than buying it now and holding it for a longer period of time. But that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.